Hello Sector Watchers, welcome to the 32nd episode of Sector Spotlight on Tuesday the 26th of May, recorded on Memorial Day the 25th of May. I hope you all enjoyed your long weekend and had a thoughtful day yesterday. Sector Spotlight airs every Tuesday from 10:30 to 11 AM Eastern, and you can watch the replay on the StockCharts YouTube channel. If you do happen to watch the show on YouTube, please let us know what you think in the comments below the video. Today's show is all about RRGs and relative strength charts. Let's start with an overview of the performances of the various asset classes, or at least the ETFs representing various asset classes that we're tracking here in Sector Spotlight. The chart on the left is the daily RRG for those asset classes, and as you can see, it was a pretty good week, especially for the risk assets. Topping the list is the real estate sector with 6.9%, followed by the stock market, the total US stock market with 3.8%, not as good as real estate, but still a very good performance for stocks. And then we also had some good performances for high yield and surprisingly enough for commodities. At the bottom of the list we find government bonds and corporate bonds. Now, if we look at the rotations, we see that real estate is still way down in the lower left hand corner of the lagging quadrant, and we see that the stocks are still the only asset class at the right hand side of the plot. Government bonds are in sight improving and moving down, so I'm watching this rotation between stocks and government bonds closely, and it looks that at least for the short term the rotation is still in favor for stocks over government bonds. Let's take a look at the weekly RRG to put all of that in perspective. And here you see the weekly RRG for those asset classes, and you see that stocks are still in lagging, although they are rising on at least on the momentum scale over the last 3 weeks. But government bonds are still way ahead, inside leading, and coming down over the last 3 weeks. So it's a little bit of a balancing act to figure out what asset class should have the preference, and I think that we have to divide that back into time frames. If I look at the weekly chart here on the left, I think that we should be very careful with overweighting stocks, but because they are still in the lagging quadrant, they're hicking up a little bit on the momentum scale, but they're far to the left, which means that they went through a very large underperformance period and they're now recovering from that. And the same goes in the other way around for government bonds that did very well and are now sort of taking a break. And that is what we see in that daily RRG over the last 5 days, where we see that government bonds are rolling over but still to the left, and stocks are curling up and still to the right. So the short term favors stocks, the long term favors bonds. Now, there is no right and wrong answer here. It completely depends on your time frame, how you want to position your portfolio, but just be aware of the fact that there are two different time frames in play here. And on the longer term, I am still pretty cautious for the stock market. In the short term, it looks as if there is a little bit more fuel left in the tank to take this market a little bit higher. If we look at the graph on the right, that's the weekly price chart for ITOT, you see that we're breaking above this former support, now resistance level. That is good. And what's also encouraging is that we are breaking back above that former support level in the relative strength line, and that's the ratio against VBINX. So from that perspective, as I said, a little bit more fuel left in the tank for stocks. Now let's take a quick look at government bonds, and you see that they are still pushing against that resistance level around 28.25. Again, this is in the long term, this is still pretty good. Look at that rotation here. that is still strong. This could easily rotate through weakening and back up, and ITOT could easily rotate inside improving and back down. But in a few weeks, that can mean a very good performance for stocks over government bonds. So I'm kind of juggling. You can probably hear it in the way I try to phrase it, to make sure that we're looking at the right time frame and that we're looking at the right positioning on what we want to do. So here in the weekly chart for government bonds, I'm still watching that resistance level very, very closely, but as long as it's not breaking to the upside, government bonds are probably moving sideways, maybe a little bit lower, and that ties in with that shorter term picture where you see government bonds rolling over, inside improving and going down. Okay, so far for asset classes at the moment. Let's move to the performance for the sectors, and let's bring up the daily RRG here for sectors over the last 5 days. I have to make that's the last week. So if I rank the percentages, we see the performances per week, and let me make a quick weekly version of that to put everything back into perspective. And then here we have some charts available later on. Now, if we do this for sectors, we see that in line with what we saw in the good performance for stocks on the asset class RRG, we see a very good performance for basically for all sectors across the board, not surprisingly if the market went up. Basically, there's only one sector that shows a negative performance. That was healthcare this week, minus 0.8, and the winner was industrials. But what is more interesting to see is that this whole cluster of, let's put it like the top 4, and then with a little bit of doubt for real estate, but these are risk-on offensive sectors, while the traditional defensive sectors are found on the downside: utilities, staples, and healthcare. Now, if we look at those individual rotations, I want to highlight a few sectors that I want to bring forward, and let me also bring that into the weekly RRG, so we can bring both pictures together. If I center it, I like the centering because you can see how the spread is. So there's still a big tilt to the lagging quadrant, and the stuff that's inside leading is not very far inside leading. So I can see the spread on the RS ratio scale, how that is tilted, and it's tilted to the negative side in this case. Let's do the same here for the daily. That's more evenly spread. Now, if we go to a few interesting sectors, the one that I want to highlight here is communication services. We spoke about that a few times already, actually. I wrote an article about it last week. Let me bring up communication services here. And you see that this sector bounced off a very important support level, the December 2018 low. And then we rallied back up in almost one straight line, went through this former resistance, support, now again resistance, but as if it didn't exist, and we're now pushing above this horizontal level around 53 roughly. And on the RRG, you see that the rotation is starting to pick up. It was one of the sectors, or it was this sector that was very close to the benchmark for a long time. And now it's starting to move away from that further into the leading quadrant. And if we do that on the daily scale, we see that it is rolling over now, taking a little bit of a break after that recent strong move up. What I take a note of this note here on the chart. We discussed this in a previous version of Sector Spotlight. The seasonality for May for communication services showing a 75% outperformance over the last 20 years, and the average outperformance was 1.1% over SPY. I'm going to come back to that later on. But all in all, communication services still a pretty good sector. Now, The other sector that we looked at on a seasonal basis in a previous version was financials. And you see that here on the daily RRG it is moving up where communication services was going down, so they're moving in opposite directions. But if we look at the weekly version, you see communication services shooting into the leading quadrant, and you see that financials are inside lagging. Very little pickup in relative strength momentum over the last 2 weeks, but still moving further down on the RS ratio scale. And if I bring in the chart of XLF, we see that it also found support at an important horizontal level, not the December 2018 low. We actually broke that relatively easy. But we found support at the cluster of highs that was made in 2015, 2016. And we're now sort of struggling. What is really bad is the move of the relative strength line, which dropped to new lows, and this is a very clear downtrend. A little bit of stabilization and momentum, but that trend is still down. But note this note on the May seasonality that showed a 65% underperformance for May, with an average underperformance of minus 0.2 below SPY. Now, May so far has had 16 trading days. If I bring this RRG to 16 trading days, we can see what the performance month to date was for those sectors. Now watch this. If we sort this sector, this RRG on percentage performance, so this column now shows the month to date performance, we see that communication services is actually the top performer inside sector universe for this month with a performance of 6.8%, while XLF is the worst performer of the universe of sectors with a performance of minus 3.8%. So this seasonal call worked out pretty well, I have to say. Communication services is way outperforming, financials is way underperforming, and the expected outperformance for which was for financials minus 0.2 is here. So we got to take 1.7 minus 3.8, so that's way over 5% outperformance or underperformance, excess return on this scale. So financials underperforming more than 5% under SPY for this month, while communication services, let's bring up that chart once more, was expected to outperform, or on average is outperforming 1.1% over SPY in the month of May, and is now actually outperforming 6.8 minus 1.7, so that's 5.1%. So 5% outperformance and 5% underperformance. Pretty good result for this seasonal trade, seasonal pattern, seasonal view that we brought there in the previous version of Sector Spotlight. Let's have a quick look at the energy sector because it continues to intrigue me. Let's bring that to 5 days, so that's what we've been looking at for the whole time. On the daily, we see this jiggly move. It went through a very nice rotation, as you can see. We talked about it a few times. It's starting to move back to the left right now. And if we look at the weekly RRG, you see that energy has been picking up pretty strongly on the RS momentum scale over the last couple of weeks. But it is still far away to the left. As you can see, there's still a big gap between energy and financials, which is the second worst sector in this universe. Now, if we bring up the chart for XLE, you can see why that is. We have this big downtrend in relative strength still in play. That's positioning, that's putting that XLE trail right on the left here. This little consolidation over the last, it's already maybe a month, is causing this RS momentum to pick up. It's reacting pretty aggressively because the downtrend was so strong, which is causing this little hiccup here. But it's very low on the RS ratio scale, which makes me very reluctant to become overly bullish on the energy sector. For the short term, it's still pretty good, but you can already see that on the bar chart here, we are rapidly approaching the top of the gap, which is at the same time a very important previous low, which was support and is now expected to start acting as resistance. Now, if we bring that back with the energy sector here on the tail, you see that it sort of has run its course, I think. That recovery, rotation through leading, rolled over, is now into weakening and now starting to move to the left, back to the lagging quadrant, where it could very well cause the tail of energy to maybe have a little bit more fuel, a little bit more stamina to move over into improving and then roll over back down again, because I think it's still too far away from the 100 level to expect a rotation all the way into leading without any setback, and that's exactly what this chart is telling me. Maybe there is a little bit more upside left. I think this resistance level here is 41.50, let's say 41.50 versus 38.50, so that's $3 more left. It's a decent percentage on this price level, but I think the risk is pretty big. So yes, a little bit more upside left for energy, but that's probably it, because it is still the weakest sector in terms of the RS ratio scale. Another sector that I wanted to look at is communications, consumer staples, rolling over on the weekly, heading down to weakening, and if we put it on the daily, you see that it is inside improving, but also already to start roll over again. So this is a suggesting weakness ahead, and if we look at the price chart with the RRG lines on it, you see that the staple sector wasn't able to push higher. We're now coming off this high, moving lower, but what I really don't like is the fact that we did break out of this long range, which was suggesting positive signals, and we broke back below this range. And I think you've heard me say many times before with ranges and channels, when a market breaks out of a channel or out of a range, in essence that's good as long as it can hold that break. But if it breaks back into that channel, or in this case back into that range, it very often leads to a test of the opposite side. So in this case, with a break back into that range, you can expect a test of the lower boundary of that range, and that is what we're underway to right now. So there's a little bit more weakness and relative strength to come before we hit that level, but look at the momentum. It's deteriorating rapidly. The high in the RS ratio is in. It'll be confirmed when the green line crosses below 100. And what you will see then is that it crosses into the weakening quadrant. Consumer staples, I'd be very careful with this. It's a defensive sector, and with a long-term cautious approach to stocks, I would expect a little bit more from staples, and I don't see that yet. Maybe it's a sign. Maybe it tells me that I should pay more attention to the current strength in the stock market as a whole. Maybe it tells us that there is a more risk-on move underway that just needs a little bit more confirmation. And that brings me to XLY, because the XLP, XLY, staples, discretionary can very often give you a good gauge. Now, we have discussed a couple of times already the fact that Amazon is a big part of the consumer discretionary sector. The equal weight version of this sector does not look as good as this one, but if we would trade this universe, then XLY is definitely the better one over XLP. So trying to make sense of this whole rotation, offensive, defensive, trying to stick with what I really see. And as I said, what I see here is that staples are rolling over, going from leading towards weakening. And if you look at discretionary, they are actually moving into the leading quadrant. So there's a preference for discretionary over staples. I don't know, maybe it's a short-term thing. We'll have to wait and see. Just want to make you aware of the fact of these observations that we're seeing right now. Now, one more that I wanted to share with you. We saw that real estate was a very good sector on the asset class level. It is still far away to the left there. It is a weak sector in the S&P sector universe. We moved into the lagging quadrant very, very clearly. And if we look at the daily version, we're inside lagging, but we have this little recovery rotation, so to say. And what you see on the price chart is that real estate actually bounced off this. It bounced off that resistance level. We're now somewhere midway, but we are at the low of this range, at this support level in terms of relative strength. And with these RRG lines moving so sharply lower, the odds are quite big that this will not hold and that the real estate sector will break lower in relative terms, which will put more fuel on the RRG lines to move lower. And as you can see on the price chart, there is plenty of room to move. Well, let's say 27 is the first sort of serious support level that you can watch. Okay, maybe 29 if you forget this crazy move here. But still, in price terms, that is at least 10% to the downside. So in this sector universe, be very careful with the real estate sector, despite the pretty strong support that we had this week. So I wanted to wrap it up, but I need to show you one more, and that is the utilities sector, because that is also, well, I put here, utilities, insight improving on the daily, but far to the left, as you could see, and just crossing over into lagging on the weekly. And this is not a very strong rotation. So this is another defensive sector together with staples that went from leading through weakening and now into lagging. And if I look at the price chart here, it had trouble. It played with that resistance around 60, failed to break higher. We had just 1-2 peaks slightly above that level, dropped back. Now back into this big void area where there is plenty of room for a move to 49, 46. So again, that's percentage terms, it's a big move. But look at this, look at that relative strength line that is breaking below this horizontal level that we've seen basically all of this year with the RRG lines rolling over. So again, this is another defensive sector that is not acting as you would expect in a defensive environment. So can you imagine what's happening in my head where I see the weakness on the longer term, but it's improving, and I see the improvement on the shorter term RRG, where stocks are still getting more fuel and getting higher and moving it towards that leading quadrant. So I am the bigger picture for me, stocks, you need to be cautious. But I'm getting a lot of signals with the short-term rotation on the RRG and the defensive sectors losing relative strength, that start to lean like, hey, maybe this is not a bear market rally, maybe this is something bigger. It's way too early to tell, and we need to continue to monitor it very closely. But it is something that is on my radar screen and on the RRG for you to track. Please keep an eye on it, because this is a very difficult market that can change like overnight. So we need to stay alert. But for the time being, stocks are doing really well. And I have no idea how long, maybe much more to come. The short-term signals are all in favor of a strong stock market. The longer term is picking up. Maybe it will turn forever. I don't know. We'll have to see. Stay tuned. I will keep an eye on it here in Sector Spotlight. What does it all mean for our investment pyramid as we deal with it every now and then here in Sector Spotlight? As you can see, no changes in the top line. All asset classes remain where they are, and that means relatively defensively positioned. We spoke about that at length when I did the overview of asset classes. Internationally, the S&P is actually still doing pretty well. The yield curve tends to perform better in the longer end, so the yield curve positioning should be on the longer end. And then in the sectors, I have two changes. I want to underperform utilities, XLU. We've talked about that chart. It's breaking down, it's moving into the lagging quadrant. So I really think that utilities is now an underperformer, while consumer discretionary, XLY, gets an upgrade to outperform. It was neutral when it was inside the improving quadrant and moving up towards leading. It has now entered the leading quadrant, and that warrants an outperform position. If you look at the ratings for all the individual sectors, it still remains relatively defensive, with communication services, tech, staples, healthcare, and well, discretionary is maybe the odd one out there as outperformers. And then we have utilities, real estate, industrials, financials, energy as underperformers, and materials as a neutral. We continue to update and track this overview from time to time. And let's now move to how we are going to deal with pair trades going forward. I have to be quick because we're running out of time here, but I wanted to show you the new setup on how I wanted to monitor those pair trades. That's a little bit less than one-on-one trades, but more as a group of longs and a group of shorts. And this is what I came up with as sort of a monitor or a table to keep track of what we've been talking about. At the time, we have two open of the ones that we were looking at, and that's the SPY versus IEV, US versus Europe trade. That's doing well on both legs. And the XLC, XLF trade, that's the seasonal trade that we discussed in the beginning when we were talking about sectors. And that's actually doing very well on the long leg and gives a little bit of a loss on the short leg, but overall it's still doing very well. We're going to fill this table on an ongoing basis and keep track of what we're talking about more on a portfolio type approach rather than just single pair trades. Ladies and gentlemen, this was Sector Spotlight for Tuesday, the 26th of May. Thank you for watching. I hope you enjoyed the show. If you have any questions or suggestions, please leave them in the box below the video. I'm happy to engage in any discussion. Meanwhile, if you want to stay up to date with RRGs and relative strength, visit the RRG blog on StockCharts.com and subscribe using the link below each article. For now, please stay safe and hope to see you back next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.